Hi, my name is Enrico Perotti. I'm professor of finance at the University of Amsterdam, and I'm an advisor to the Dutch Central Bank on financial stability. I'm visiting here the EUI to talk about my work on banking and financial regulation with a relatively big picture framing. So how do we protect ourselves from bank falling over, since in the end it's always us who pay? Well, we have a system of regulation which essentially establishes that banks have to have a limit to how much debt they take on, because they have to have buffers that can resist and withstand the pressure of possible losses. So I'm going to talk today at the faculty about an interesting analogy between bank stability and Dyke stability, so essentially flood control. So think of controlling the risk of bank runs as a problem that is as analogies with controlling the overflow over dikes that might lead to their compromise and degradation and collapse. Once a dike collapses, you have massive amount of water into the landscape where people live, huge damages, public costs that repairing the damage done. The analogies with bank runs, where once a bank run completely takes down a bank, you have large losses which will not be borne by the investors, and they essentially come upon the public to be absorbed, including losses that were not accounted for, that were not insured for. And the reason is that once the flood comes, it's too little to do anything because of the particular construction that banks have, which is most of their liabilities, most of their money people have in the bank can be withdrawn when people want. And that makes them very strong when people have trust and very weak when people start losing trust. So let me talk about this notion that we have spent a lot of time on norms that establish criteria for the solidity of dikes. They are calibrated to withstand water pressure based on historical level of water. And but of course, hydraulic engineers also know that sometimes water ends up being higher than expected and it starts to flow over the dike. When you start flowing over the dike, that's at first a slow process, and it's clearly an alert where you have to start to intervene and bring back material, do certain action. But sometimes the temptation might be to say, well, this is just a temporary phenomenon. Let's not create panic. Let's not spend too much money. Maybe it's just temporary overflow. It will go away. So it's a bit of a gamble that people may do because they don't want to alarm, or they don't want to be blamed, or they don't want to spend money, whatever. Of course, that's foolish, because when overflow over a dike continues, the dikes start to be eroded. So once the solidity of the dike is compromised, the key question is then its resilience. So when you think of stability, think of solidity as how strong is the structure you put in place to withstand pressure. This has to be calibrated. You have to understand what is the pressure comes there. It requires a lot of anticipation. And truly, we live in a world in which shocks, crises, come from unexpected angle or unanticipated violence. And that means that we cannot really create a system that is solid all the time. We can spend a lot on solidity, but what we also need is a system, once the shock hits, it can be dealt with. The system is able, in a sense, to bounce back, deal with the fact that it has been initially overwhelmed. how bad it is once water starts flowing over the dike. So let me talk a moment about dike engineering, and then I'll talk about banking. So once water starts flowing over the dike, the key indicator of resilience is the slope of the back wall of the dike. So farmers in Holland, where I live and work, say that a good dike is not a high dike, but is a broad dike. What it means is that what is really important is once overflow start to happen over the dike, the speed at which it falls behind the dike is a very important factor for the ability of the dike to resist the shock. Because as water falls fast, if the dike is very steep, not very wide, water falls fast. Water, by chemical characteristic, has a strong internal attraction. So once water starts falling faster, it pulls water behind it. So you have a self-reinforcing flow of water, and if the back of the dike is not solid, but it's kind of steep, then water will flow very fast, it will pull water fast, the erosion will accelerate. This is the key resemblance between a key analogy between a dike overflow and a bank outflow. When people start to withdraw from a bank, when withdrawals are above normal and people start talking about it, you are in a particular moment where it's not clear if the bank will make it or not. And this for a bank can be fatal because, when people start withdrawing because some are extremely risk averse or they need the money, you have a lot of people that don't really need the money, but they start asking themselves, what are others going to do? They're not necessarily saying, how solid is the bank? They're going to say, what is everyone going to do? So it becomes psychological almost. And so at that point in time, if you allow the outflow to continue without decisive intervention, you have also a self-escalating process where people withdrawing pulls people to withdraw. And in the end, even a bank that in principle is viable, that could be rescued, end up having this accelerating overflow. Now, what happened with the overflow damaging the crest, at some point he also impacts the back of the dike, and once the flow is fast enough and uncontrolled, unattended, you have sliding. Once you have sliding in the back, never in the front, always in the back, you have a really rapid acceleration of flow. And that's usually when the inflection point at which nothing can be done after that. So at that point you have a flood and all the consequences. Now what can be done in the flood control is, what is done typically, you have to have, as Marcus writes in his book, to have resilience. Once solidity fails, you need to have reserves, you need to have a clear mandate, and to act, you need to have stuff ready to supply. So what you need is mobilize, move sandbags, add barriers. You have to stem the flow, and to some extent redirect it in some containment basins where it won't do damage. And critically, you have to slow down the flow because you have to break this self-escalation process that will come naturally if you don't do anything. Let's move to banks. What happens nowadays when a bank, and I could think of Credit Suisse or SVB, start to lose confidence? It could be that they start to not have enough capital buffers, or it could be that people don't have confidence in the direction the bank is going. The two things are more or less the same in the end. So you could have banks like Credit Suisse that actually comply with the criteria for solidity still, but they are deteriorating, and everybody can see down the line that in the end, it will not survive on the current path. What is important at that point is intervention, prompt intervention. And right now, in banking regulation, we have a fundamental flaw that we focus very much on the front, the solidity of the Pillar 1 measure. And we have too little attention and support for what you do once the banks start to be in breach of the sort of prudential norms. Right now, what happens is that we have supervisors, the one that should intervene at that point, and shareholders playing a funny waiting game, hoping the problem goes away. And from the bank shareholders, it's sort of understandable why they like to gamble. I mean, they hope to recover without spending a penny into it. For supervisors, the problem is essentially that supervisors face difficulty because there are legal ambiguity about what you can really do. There are norms, but they are not so clear. And so sometimes supervisors, as in the case of Switzerland, they don't dare to intervene for months, for years, even though the situation is deteriorating. A second problem is that supervisors are very concerned that any action would become a public signal that might create essentially panic or it will escalate outflows. So this fear runs is what stops people from acting in time. So what happens is that the banks come into some trouble, too little is done, people hope it goes away. If you get lucky, it goes away. And if you're not lucky, the situation keeps deteriorating, and the longer you are inactive, the worse things are, because of course when you are hiding trouble in a bank and you are protecting very poor risk incentive, you're hiding loss, news can only be bad in a sense, the situation inside the bank will deteriorate. And so you make things worse by not acting in time. So my work that I presented in many places before here, the Bank of England, the ECB, the Central Bank, the Single Resolution Board, and other places in the last year, is a set of measures that would essentially allow a clear mandate to be established upon signals that are the traditional signal of accounting regulatory norms, and some as being market signal, like prices or outflows. And there would be then a legitimate mandate to intervene decisively. Intervene decisively can mean a number of things. One specifically is the ability to convert some of the debt into equity. There are special bonds issued exactly for this purpose that pay a good return to investors to bear this risk. And they are currently never activated before default, so they are completely failing as resilience instrument. There are other norms that involve, other intervention can involve changing the risk profile of the bank, governance move, clearly possibly prepare for a merger. So these are all actions done not under the pressure necessarily of a run, but anticipating or containing a run. But what happens once these actions are taken? Will a run be triggered? Because people say, oh my God, there is a problem here. So what the last part of the proposal, and the part that is on one hand very innovative in banking, but not very innovative when you look at the large experience of quasi-banks, such as money market funds in the US, is that when you have large outflows, you would establish the principle that all uninsured depositors, typically corporate account, the large account that are not under deposit insurance, so deposits not by people but essentially by firms and large firms and investors, would be able to withdraw, as usual, but only at a penalty. So they would pay a redemption charge, which would essentially throw some sand into the wheel of the run. And if I suddenly know, so let's say you have a rapid outflow and automatically you have a charge imposed on all those uninsured depositors that wish to withdraw. I mean, normal people could withdraw fully with no cost. What happens then to these investors? Well, right now the temptation is, well, there is some doubt. I mean, of course they pull out. Just in doubt, why would I run a risk? Once you have to start pay a penalty, you would say, first of all, well, why would I want to leave 3% of my money down because I want to withdraw today? I mean, I could wait a month and maybe it goes away. But will it go away? So the second part is the effect that this has on the psychology, meaning that it's not just me who say, wait, it's going to cost me to withdraw now. I also realize everyone else is facing that cost. And that breaks that expectation that, of course, everybody will withdraw. I will start to say, wait, maybe also, why would others withdraw? Once you break that strategic ambiguity, once you break that narrative that the run is essentially unavoidable, then you have created a chance to sort of stem the progressive escalation of outflow into a run, and for a period of time, give a chance to supervisors to act and readdress the situation. So this is a comprehensive package of reforms, which is being presented in various forums and is getting quite a bit of attention. I look forward to discuss that with the faculty here.